October 2001. A live earnings call. Hundreds of Wall Street analysts listening in. An analyst named Richard Grubman asks a simple question. He wants to know why Enron is the only major energy company in America that refuses to release a balance sheet with its earnings. The CEO of a $60 billion company pauses. Then, into a live microphone in front of the entire financial world, Jeff Skilling calls him an asshole. He resigned as CEO 90 days later. The company was bankrupt 90 days after that. 20,000 people lost their jobs, their pensions, their life savings. This is the story of Enron, the company that didn't just commit fraud, it invented an entirely new language to hide it. To understand what Enron did, you have to understand what Enron was supposed to be. Founded in 1985 from the merger of two natural gas companies, Enron started life moving gas through pipes. Boring, physical, predictable. At the top was Kenneth Lay. Charming, politically connected, a PhD economist who genuinely believed he was building America's energy future. For 6 straight years, Fortune magazine named Enron the most innovative company in America. Presidents visited their offices. Members of Congress took their calls. The financial press called their executives visionaries. But the real architect of modern Enron wasn't Ken Lay. It was a man named Jeff Skilling. Skilling arrived from McKinsey in 1990 with one obsession. He wanted to turn Enron into a trading company, not a pipeline company, a bank for energy. He wanted to buy and sell energy contracts the same way Goldman Sachs bought and sold financial instruments. To do that, he needed to change one thing first. He needed to change the accounting rules. Here is how accounting normally works. A company signs a contract. The work gets done. The cash arrives. Then, and only then, the company books the revenue. Simple. Conservative. Tied to reality. In 1991, Jeff Skilling went to the Securities and Exchange Commission with a different idea. He called it mark-to-market accounting. The concept was already used by Wall Street banks for trading securities. Skilling argued that if Enron was really an energy trading company, they deserved to use the same rules. The SEC agreed. In 1992, Enron became the first non-financial company in America granted permission to use mark-to-market accounting on long-term energy contracts. This is where everything starts to rot. Under mark-to-market rules, the moment Enron signed a 20-year gas supply contract, they could book the entire projected profit of that contract. Right now. Today. Not when the gas was delivered, not when the cash arrived. The cash might take 2 decades to arrive. But the profit showed up on earnings reports this quarter. Wall Street saw rising profits. Enron's stock climbed. But there was a fundamental problem. A company that books revenue it hasn't collected yet needs to put something on its balance sheet to cover that gap. That something is debt. By the late 1990s, Enron was booking phantom profits every quarter and quietly accumulating billions of dollars in real debt. They needed somewhere to hide it. Enter Andrew Fastow, Enron's chief financial officer. The man Fortune once named one of the best CFOs in America. Fastow's genius, if you can call it that, was a financial structure called a special purpose entity, or SPE. A special purpose entity is a legal subsidiary, a separate company created for a specific financial purpose. Banks and corporations use them all the time, for legitimate reasons. Structured finance, asset securitization, risk isolation. Fastow used them as a trash can. Here is how it worked. Enron created these SPEs, dozens of them. They had names like LJM Cayman, LJM2, Raptor 1, Raptor 2, Raptor 3, Raptor 4. Enron would transfer bad assets, underperforming investments, accumulating debt, off their own balance sheet and into these SPEs. To investors and analysts looking at Enron's annual report, those liabilities had vanished. But they hadn't vanished. Enron had secretly guaranteed those SPEs, meaning if the SPEs ever collapsed, Enron was still on the hook for every dollar. The debt was still theirs. It was just invisible. Now here is where it gets criminal. Fastow didn't just create these entities for Enron, he personally managed them. LJM Cayman, LJM2. Fastow used his own initials. He named these things after himself, his wife Leah, and his son Michael. While drawing a salary as Enron's CFO, the man whose job was to protect shareholders, Fastow secretly collected $45 million in personal management fees from these same entities. His job was to negotiate deals that were good for Enron. He was on both sides of every single one. Then came the Raptors. In 2000, Enron had invested heavily in technology stocks. When the dot-com bubble burst, those investments were bleeding billions in losses. Fastow created 4 SPEs, the Raptors, specifically to hedge those losses. The Raptors would pay Enron if its tech investments fell. It sounded like insurance. But there was a catastrophic design flaw buried in the fine print. The Raptors were capitalized almost entirely with Enron stock. So when Enron's stock price fell, the very insurance policy designed to protect against losses was itself becoming worthless. By mid-2001, the Raptors had a $1 billion hole in them, and Enron was still pretending on paper that they were healthy. This was not aggressive accounting. This was not a gray area. This was fraud. The first crack came not from regulators, not from auditors, from a journalist. In March 2001, Fortune reporter Bethany McLean asked a question that should have been obvious. How exactly does Enron make its money? She'd been given Enron's annual report and couldn't figure it out. Neither could the analysts, she asked. Enron's response was to fly McLean to Houston and have Jeff Skilling explain the business to her personally. She still couldn't understand it. At the same time, a Wall Street hedge fund manager named Jim Chanos was quietly shorting Enron stock. He'd noticed the same thing: extraordinary earnings reports, a balance sheet that made no sense, and a stock price that depended entirely on Enron's own continued momentum. Then, in August 2001, a vice president inside Enron sent a 7-page memo directly to Ken Lay. Her name was Sharon Watkins. In the memo, she wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals." Ken Lay had Enron's lawyers investigate. The lawyers, hired by Enron, paid by Enron, concluded there was no problem. By October 2001, the earnings call happened. The asshole comment. Skilling was gone. In November, Enron restated its earnings, wiping out $600 million of profits that had never actually existed. By December 2, 2001, it was over. 20,000 employees showed up to work one morning and found the doors locked. Their 401k pension plans, which Enron had encouraged them to fill with company stock, were worthless. Investors lost over $60 billion. Arthur Andersen, Enron's auditor, one of the 5 largest accounting firms in the world, was criminally convicted for obstruction of justice. They shredded documents by the truckload as investigators closed in. They were destroyed. 85,000 people lost their jobs at a firm that had nothing to do with the fraud. Kenneth Lay was convicted on 6 counts of fraud and conspiracy. He died of a heart attack in July 2006, 3 months before his sentencing. Jeffrey Skilling was sentenced to 24 years in federal prison. After years of appeals, it was reduced to 14. He was released in 2019. Andrew Fastow, the man who built the SPEs, who collected $45 million for himself while hiding billions of debt from the people he was supposed to protect, served 6 years. He now gives lectures on corporate ethics. The Enron scandal is taught in every business school in the world, and yet the mechanics behind it are almost never explained clearly. Mark-to-market accounting is not inherently fraud, but when you allow a company to book speculative future profits today, and then use off-balance sheet entities to hide the debt that builds up while you wait for those profits to arrive, you've built a machine designed to deceive. And here is the most dangerous part. Enron's complexity was a strategy. The more incomprehensible the financial structure, the fewer people could challenge it. The analysts who asked questions were told they didn't understand the business model. The journalists who raised doubts were accused of trying to crash the stock. The auditors at Arthur Andersen signed off on it year after year, collecting millions in consulting fees from the same company they were auditing. When a corporation makes its own finances impossible to understand, that's not complexity. That's camouflage. The next Enron is already out there. It's filing earnings reports every quarter. Wall Street is rating it a buy. The only defense is knowing exactly what to look for. Hit subscribe, because next week we open another ledger. We expose the books every single week.